Good morning and welcome back to Almus Market Mornings. All right, so oil is steadily moving higher, so are bond yields. Yesterday, the US 30-year yield hit its cycle high of 5.33%, and it seems that the trend of bond market sell-off is continuing. There is no progress on the war front. Ceasefire has expired, and there are primary exchange of statements which are not bringing any comfort to investors. What's also interesting is that while there is a bear steepening going on in the US, there's a curve flattening going on in China. Today morning, equities also seem to have taken a bit of a hit, especially the chip bellwether stocks and AI related sectors, possibly due to the sharp risk aversion kind of scenario building up. Good morning, JK. So there are multiple angles we are tracking. We are seeing movement in most asset markets, but the currencies, dollar index or euro, all these currencies are quite steady. What is your reading about this?
Good morning, Swaraj. Um, yes, the currency market is steady relatively, and probably, in my view, it's going to be temporary. Let me start with the USDINR. It's trading well above 95.70 levels now, steadily building on the gains since breaking the 95.50 resistance. We did have sporadic intervention by PSU banks on the way up. They've only been able to slow the rise but not stop it, and perhaps not stopping it as well, because the move now is more based on global headwinds and other challenges of higher oil price and bond yields going up, and it's probably not so much driven by speculation as well. So they have let it fall gradually, and the movement has been gradual but very decisive, and it is moving towards 96 initially, and technically, certain chart formations indicate that we can move to 96.50 as well, and this is, of course, despite the FCNR flows being very robust, and even within the next 10 days, 12 days to go, the flows can touch up to 80 billion as well. But we are all aware that RBI has dollar liquidity now to intervene more, but they will be very selective in intervention. And it also, whatever the accumulation of dollars in the near end is also matched by forward liabilities. So they will be judiciously intervening as and when there is a larger move happening, or it is driven by speculation. So right now, dollar P is on an up move. Initial target, I feel, 96. It will not come in a hurry, but it will go gradually. Now, on the global markets, Trump's decision not to extend the MOU that expired on Monday and his threats to bomb Oman, if the agreement between Oman and Iran to open the Strait of Hormuz does not include US, added worries about a prolonged energy supply disruption. We have always been pointing out about the depleting SPR, the strategic petroleum reserves, which was offering some sort of a backup earlier, and that probably is not going to be there if the escalation happens, and the strait does not open for much longer period. Diplomatic efforts have definitely failed so far. If it does happen, it's going to be a positive surprise for the market. Now, that has a direct bearing on the bond market, which you mentioned, 30-year hitting a 2007 high. In fact, yields in Japan and Germany have also hit a new high now. So yields are rising all across the regions, and the dips have been very shallow. This is all despite some weak set of numbers that we have seen: job market, inflation numbers subdued, PPI and CPI, and then the retail sales, consumer sentiment, all coming lower. In fact, yesterday we had another indicator: housing starts fell by more than 12% in July. And this is driven by high housing prices, which have been high, and the mortgage rates, which have moved up by more than 60 basis points in the recent past, from around 6.10 to 6.70, 30-year mortgage rate. So I think you can add one more sector for the weakness in the US economy. So all this, in fact, is eventually telling upon the US stocks, which weakened yesterday in all the three major indices. The old economy stocks weakened because of the higher yields and weaker economy, and the uh, tech sector slumped because of renewed concerns about returns on the huge investments, even as the lending costs are going up. The Philadelphia Semiconductor Index had a big gap down. Similarly, the Nasdaq index had a big gap down. Technically, these indices now look for more losses. So I think definitely the risk sentiment is taking a hit. And like you said, the USD generally is very gradually moving. That is because currently the market is not into full liquidity. There is the vacation period in the Western Hemisphere that's keeping the volumes low. But I'm afraid come September, we are going to have a huge burst of volatility because all these factors, if they don't reverse, that the bond yields or the weakness in the economy and the oil price rise, if they are not reversing, I think we are going to burst up in volatility definitely, and the dollar is probably set to weaken against the major currencies. EM currencies, on the other hand, will also weaken against the US dollar. But for now, it's relative stability, or you can say calm before the storm for some time. That will be observed, and definitely the focus remains on two currencies, the Chinese yuan and the Japanese yen, about which we touched yesterday also. The Chinese yuan, after a weak set of economic numbers, looks like the support from large or the very strong export performance is now going to wane, and it looks like the exporters are now selling less out of their export earnings, large export earnings, and that could result in USD CNY finding a bottom. Even the Central Bank of China might stop it from appreciating further, because more appreciation can lead to further deflationary pressure as well. In USDN, it is clearly a battle between the market and the authorities. US-Japan joint intervention haven't yielded the result that they would have desired, although it is down from where it was before the intervention. It's again pushing higher towards 160. Market's perception of fiscal difficulties in Japan is not matching with that of the authorities, and Japanese central bank is not hiking rate as it is required, keeping the real interest low. So all this eventually, I think, as we move into full liquidity market, I think we're going to see a much more action, definitely in the currency market, and perhaps in the stock market as well, which have been somewhat held steady, particularly in the US. But I think it's not going to be steady for too long. Thank you.
Thank you, JK. And yes, we discussed the yen and the yuan. It seems that the appreciation in yuan may be finding a temporary halt as the move. It seems to be a bit overextended, and the central bank seems to be purchasing dollars aggressively to prevent any undue appreciation. While in the yen, we are seeing the joint intervention confidence that seems to be waning. USDINR is gradually moving higher. There are some interventions by the central bank, but they really haven't tried very hard. It's been gradual. The move also has been gradual. The global headwinds for the rupee have also been quite negative. Higher oil prices and higher yields. So there is some sort of a gradual move we are seeing towards dollar strength globally. Otherwise, the threats by President Trump, they remain in play. There's not really a big resolution that is being expected by the markets when it comes to the US-Iran war. And generally, investors would be thinking about the SPR depletion and the pressure on oil prices. And if that doesn't come sooner, then we are seeing oil prices, gradually the way they are moving, they would continue to inch up. Yields across are moving higher, Japan, Germany, US, all of this happening despite weak economic data. So, very interesting set of time currently prevailing in the markets. We'll catch up on these themes again. That's it from us today. Thanks for listening. We'll catch up tomorrow with a fresh round of updates.